Are you looking for affordable ETFs that pack a punch with high growth potential, steady income, and unbeatable value? Well, you're in the right place. Today, I've got 8 hidden ETF gems, all priced under $100, that could set your portfolio on the path to serious gains. From high dividend payers to sector-specific growth stars, these ETFs have the potential to deliver double-digit returns while providing stability in an unpredictable market. Whether you're seeking safe bets, growth plays, or a mix of both, these funds have something for everyone. So stick around to find out which ETFs you need to buy before 2025. Quick reminder, if you're ready to unlock the secrets to smart investing and supercharge your portfolio, be sure to subscribe and tap that bell so you're the first to know when I drop more game-changing ETF picks. Now let's dive in. Let's kick things off with one of my favorite hidden gems, the Pacer US Cash COWZ 100 ETF, or COWZ. If you're looking for a fund that delivers strong returns with minimal risk, this is one you definitely need on your radar. COWZ focuses on the top 100 US companies with the highest free cash flow yield, meaning these companies generate a ton of cash after covering all their business expenses. What does that mean for you as an investor? More cash means more opportunities for growth and potential stability during volatile markets. Let's talk numbers. COWZ has a market price of $58 and controls a hefty $25.2 billion in total net assets. It comes with a reasonable expense ratio of 0.49%, making it fairly affordable for the value it offers. Plus, you're getting a dividend yield of 1.86%, with $1.09 paid out per share over the past year. And those payouts come in every 3 months, giving you a steady stream of income. But what really makes this ETF shine is its performance. Year-to-date, COWZ is up 12%, and over the past year, it's delivered an impressive 18% return. Now, if you're thinking long-term, you'll be happy to know that COWZ has a 103% return over the past 5 years. That's doubling your money. Now let's dive into the fund's sector breakdown. It's heavily weighted towards energy at 21.6%, with top holdings like Chevron and EOG Resources. But it's also got a diverse mix of consumer cyclical stocks at 21.4%, technology at 20.9%, and industrials rounding out 10.4% of the portfolio. This spread means you're getting exposure to some of the strongest sectors in today's market. And let's not forget the top holdings. Names like Nucor Corporation, Qualcomm, Chevron, and Bristol-Myers Squibb lead the charge, each making up about 2% of the fund. These are companies with solid balance sheets and strong cash flow, so you're in good hands. Our second ETF is truly unique, one that combines cutting-edge innovation with a massive dividend yield. Introducing the Clockwise Core Equity and Innovation ETF, or TIME. If you're looking for a high-growth opportunity in the tech and innovation sectors, this ETF might be exactly what you need. TIME is priced at $28, making it affordable. But what really catches the eye is its incredible 20% dividend yield. That's one of the highest yields you'll find in an equity-focused ETF. But remember, such a high yield comes with risks, and it's important to keep an eye on whether that dividend is sustainable long-term. In terms of performance, TIME has been impressive. It's up 38% year-to-date and has posted a solid 30% return over the past year, making it one of the top performers in its category. The expense ratio sits at 0.95%, which is a bit higher than some other funds, but for a fund this specialized, it's not unusual. TIME's strategy is what makes it so exciting. It focuses on companies that save people time and drive innovation. Think tech giants and future-forward industries. Plus, 10% of the fund is allocated to T-bills through the SPDR Bloomberg 1 to 3 month T-bill ETF, providing a buffer of stability. The combination of growth stocks and safer T-bills gives TIME a unique edge. So what's under the hood of this ETF? The top 10 holdings make up 48.31% of the total assets, with a strong focus on innovation leaders like NVIDIA, 5.86%, Robinhood, 4.66%, Apple, 4.04%, and Alphabet, 4.00%. These are companies that are shaping the future of technology, AI, and digital services. Add to that the likes of Amazon, Meta, and Microsoft, and you've got a who's who of industry giants driving this fund's performance. Sector-wise, time is heavily weighted in technology at 30.81%, followed by communication services at 21.00%, and even has exposure to energy and consumer cyclical sectors, providing diversification across industries. This broad sector mix gives you both the high growth potential of tech and innovation, along with the added stability from sectors like energy and financials. If you're looking for a defensive play with exposure to one of the most critical sectors in the economy, look no further than our third ETF Energy Select Sector SPDR Fund, or XLE. This ETF focuses on some of the largest and most powerful energy companies in the world, making it a great choice for both growth and income seekers, especially in uncertain markets. Let's get into the numbers. XLE has a market price of $90 and controls a whopping $35 billion in net assets, making it one of the biggest players in the energy ETF space. One of the standout features of this fund is its super low expense ratio of just 0.09%. So you're not paying much in fees to own this juggernaut of an ETF. When it comes to dividends, XLE offers a solid yield of 3.25%, with quarterly payouts. This makes it an attractive option for income investors who want exposure to the energy sector, which has historically been a strong performer, especially during periods of inflation or rising oil prices. Now, let's talk about its performance. Year to date, XLE is up 7%, and over the past 5 years, it has delivered an impressive 59% return. This shows that energy has been a resilient sector, bouncing back strongly from market downturns, and with the global demand for energy continuing to rise, the outlook remains positive. XLE's portfolio is concentrated, with just 25 holdings, but don't let that fool you. This ETF gives you exposure to some of the biggest names in energy. The top 10 holdings make up a significant 74.87% of the fund's total assets, and at the top of the list, you'll find industry giants like ExxonMobil, 23.29%, and Chevron, 15.49%. These two alone account for nearly 40% of the fund. Other key holdings include ConocoPhillips, Schlumberger, and EOG Resources, all of which are major players in the oil and gas industry. Sector-wise, XLE is heavily invested in oil, gas, and consumable fuels, as well as energy equipment and services. So, if you believe in the continued importance of traditional energy sources, or if you're looking for a hedge against inflation and market volatility, XLE is a solid choice. Energy companies tend to do well in inflationary environments because rising oil and gas prices boost their revenues, and this ETF gives you a front-row seat to those gains. Next up, let's shift gears into one of the most exciting sectors out there, semiconductors. If you've been paying attention to the tech world, you know how critical semiconductors are to everything from smartphones to electric vehicles. The Invesco PHLX Semiconductor ETF, or SOXQ, is your gateway into this high-growth sector at a reasonable price. SOXQ is currently trading at $41, making it a solid choice for investors looking to get into the booming semiconductor industry without breaking the bank. With total net assets of $507 million, this ETF is smaller compared to some of its peers. But don't let that fool you. It's packed with big-name companies that are driving the future of technology. One of the highlights of this fund is its low expense ratio of 0.19%, which means you're paying very little in fees to get exposure to the best semiconductor companies in the world. The dividend yield sits at 0.65%, so while income isn't the main draw here, you're still getting a little bonus in addition to the fund's growth potential. And speaking of growth, SOXQ has been on fire this year, with a year-to-date return of 29%. And over the past year, it's posted a stunning 52% return. That's what makes semiconductors such an attractive investment. This sector has the potential for serious gains, especially as demand for chips skyrockets with the rise of AI, data centers, and electric vehicles. The top 10 holdings of SOXQ make up 62.73% of the fund's assets, and these are the companies leading the charge in the semiconductor revolution. Names like NVIDIA, Broadcom, Advanced Micro Devices, and Taiwan Semiconductor Manufacturing are all in the top spots. These companies are not only giants in the chip-making world, but also key players in the development of cutting-edge technologies like artificial intelligence, 5G, and autonomous vehicles. With a total of 31 holdings, SOXQ provides you with a nice blend of diversification while maintaining a strong focus on the sector's top performers. You're getting exposure to a broad range of companies, from chip designers to manufacturers, ensuring you capture the full value chain of the semiconductor industry. Now, let's take a look at a fund that's perfect for those of you who want exposure to small companies with big potential: the Avantis US Small Cap Value ETF, or AVUV. If you believe in the power of small cap stocks and are looking to capture solid growth over the long term, this ETF is a strong contender. AVUV is currently priced at $98 and boasts $13 billion in net assets, making it a heavyweight in the small cap value space. One of the great things about this fund is its low expense ratio of 0.25%, which is excellent for a small cap ETF that gives you exposure to over 736 different holdings. That level of diversification ensures you're not overly reliant on any single stock, which is important in the often volatile small cap space. In terms of income, AVUV offers a 1.60% dividend yield with quarterly payouts, so you're not just getting growth here, you're also getting a steady stream of income. This combination of growth and income makes it an attractive option for long-term investors who want both. When it comes to performance, AVUV has been strong, with a year-to-date return of 10% and a 29% return over the past year. But if you really want to be impressed, look at its 97% return over the past 5 years. That's nearly doubling your investment in just 5 years. For a small cap value fund, those numbers are outstanding, showing the power of this strategy during both growth periods and market recoveries. So what makes AVUV tick? Let's talk about its sector breakdown. The fund has heavy exposure to financials at 28%, followed by industrials at 18% and consumer discretionary at 17%. It also has a significant 15% allocation to energy, making it well diversified across sectors that tend to thrive during different phases of the economic cycle. AVUV's top holdings include companies like MDU Resources Group, Boise Cascade, Alaska Air Group, and Mueller Industries. These are small but powerful players in their industries, offering a mix of stability and growth potential. With such a large number of holdings, 736 in total, you're getting exposure to a wide array of companies, each with the potential to grow as the economy expands. Next, let's talk about our last and one of the best dividend ETFs on the market, the Schwab US Dividend Equity ETF, or SCHD. If you're an income-focused investor looking for long-term growth combined with consistent dividends, SCHD is a fund you can't ignore. Priced at $28 per share, SCHD offers tremendous value, and with $61 billion in net assets, it's one of the largest and most trusted dividend ETFs out there. What really stands out is its rock-bottom expense ratio of just 0.06%. You're barely paying anything to own this fund, which is a huge plus for long-term investors who want to maximize their returns without high fees eating into their profits. Now let's talk dividends. SCHD delivers a solid 3.39% yield, paying out 98 cents per share annually, and those payments come in every 3 months. For income investors, this steady stream of dividend payments is a big attraction, and it's a great way to generate passive income while you watch your portfolio grow. Performance-wise, SCHD is no slouch either. Year-to-date, it's up 13%, and over the past year, it's delivered a 22% return. If you've held this ETF for 5 years, you've seen a 58% return on your investment, more than doubling your money over that period. These returns highlight why SCHD is so popular among dividend investors. It offers both growth and income, a rare combination. Let's take a look at what's inside SCHD. The fund holds 103 stocks, spread across key sectors with a focus on financial services, 18.14%, healthcare, 15.78%, and consumer defensive, 14.07%. These sectors provide a good mix of stability and growth, with exposure to industries that tend to perform well in both strong and weak markets. You also get exposure to energy, industrials, and technology, making this ETF a well-rounded choice for any portfolio. Some of the top holdings in SCHD include heavyweights like the Home Depot 4.26%, Verizon Communications 4.21%, and Cisco Systems 4.15%. You've also got big names like BlackRock, Pfizer, and Coca-Cola rounding out the top 10. These are all companies with strong track records of dividend payments and solid financials, so you know you're investing in the best of the best when it comes to generating income. So, why should you consider SCHD? It's an ideal ETF for anyone who wants to invest in high-quality, dividend-paying companies while keeping costs low. With its strong performance, high yield, and sector diversification, SCHD is a must-have for long-term investors looking for a balance of income and growth. So there you have it. 6 powerful ETFs under $100 that offer everything from growth and dividends to stability and innovation. Whether you're looking to capitalize on the tech boom, secure steady income, or diversify into small-cap gems, these ETFs give you plenty of options to build a winning portfolio for 2025 and beyond. Now, I want to hear from you. Which ETF are you most excited about? Drop a comment below and let me know your favorite pick, or if there's an ETF you think should have made the list. And if you found this video helpful, make sure to hit that like button and subscribe for more investing insights. I've got plenty of deep dives and strategies coming your way to help you make smarter investing decisions. Until next time, keep investing simple, and I'll see you in the next video.